Do you have a disaster plan for your portfolio?
Strike, scream, and run.
Hi everyone, I'm Marc Lichtenfeld, Chief Income Strategist with the Oxford Club. As we record this on Thursday, Southwest Florida was just pounded by Hurricane Ian, and I certainly hope that everything and everyone is as okay as possible considering this monster storm. Living in Southeast Florida, I know what it's like for a storm like this to disrupt your life.
It's raining. I don't work in the rain.
This year has been the financial equivalent of a hurricane to many investors' portfolios. The bear market has busted up a lot of portfolios, altered retirement plans, and caused a lot of stress. But it shouldn't if you have the right tools and mindset. Bear markets happen. They're not unusual, and while unpleasant, generally only last about 9.5 months on average. You can handle that. Here are a few ways to ward off a market disaster. Increase your savings. Bear markets often foretell a recession, and it's always a good idea to bulk up your savings heading into a recession, especially if your job could be in jeopardy. The extra funds will also help you increase your investments at lower prices. I'll have more on that next week. But another thing to do is make a list of stocks you'd like to buy if they get to certain prices. Writing it down makes it more concrete. Your thought process will be more thorough, and if you keep the list of stocks and prices you want to buy somewhere prominent, like next to your computer, it will be hard to ignore if the stock does get down to your price. Also, use trailing stops. The Oxford Club usually uses 25% trailing stops, and that way the most you can lose on any one position is 25%. And if you're limiting your position size of any one stock to 4% of your overall portfolio, you'll only lose 1% of your entire portfolio if you're stopped out. And that's only if you're stopped out with a full 25% loss. If the stock rises, you raise your stop along with it. And if the stock rises enough, you'll get stopped out with a profit, which is perfectly fine. I also tend to tighten my stops on shorter term trading positions as the stock rises, so what started out as a 25% stop may end up as a 10% stop. You can also use a tool like Trade Stops, which determines the optimal stops for each individual stock in your portfolio based on where you bought it. For more information on Trade Stops, visit tradestops.com. And never, ever, ever lower your stops once they're in place.
A little lower, lower, a lot lower, too low, lower.
You put them there for a reason. Don't change them because they're about to get triggered and you don't want to give up the stock. Trading on emotion is a great way to lose even more money, so don't do it.
No. I said sell when it hits 50. 50, it's a number. It comes after 49.
Lastly, if you're invested for the long term, don't do a damn thing. Like I said, bear markets happen, but stocks go up over the long term. They tend to average roughly 8 to 10% returns annually. Some years, maybe 25%. Other years, you'll lose 10%. But the long-term 8% to 10% has been consistent for decades and decades. Bear markets don't have to be disasters for your portfolio if you don't let them. So don't. To help you weather the storm, I've compiled everything you need to know about long-term dividend investing in my Ultimate Dividend Package, and it's entirely free. Simply click on the link in the description below and enter your email address to claim your free Ultimate Dividend Package. Thanks for watching State of the Market. I'm Marc Lichtenfeld. I'll see you next time.